do you buy and then sell? Now, as an individual or a business organization that is involved in buying and selling, we have to find a way of reporting the activities of such individual or business. Now, the idea is whether you are a company or an individual, large, small, medium, so long as you are involved in buying and selling, we refer to you as a trader. Now, in reporting the activities of a trader, we use final accounts for traders. A trader is an individual or a business organization involved in buying and selling. For instance, if you are involved in say distribution of flour, or you are involved in the distribution of sugar, or you are involved in the distribution of mobile phones, the idea is you are going to have to buy from somewhere, which is most likely the suppliers or the manufacturers, and then you're going to have to sell to some people, which is most likely going to be your customers or your clients. So the business being operated is called sole trading or one-man business. That's if you have just an individual involved in it. You can as well have two or more individuals, where we call partnership, or you can have a setting, where we have a bit of corporate organization of the ownership structure. Then you can be calling it a company. But regardless, so long as you are involved in buying and selling, you are a trader. Now, in the case of sole trading, the business owner has the final decision on how the business is managed. And then in sole trading as well, the capital requirement does not have to be huge to begin the business. That's more like an advantage or a merit of the business. But one disadvantage, is that if the owner of the business, in terms of sole trading or one-man business, if the owner of the business does no longer exist, or if he exits the business, it is possible that the business will come to an end. So this is basically a concentration on a one-man business, but that does not change the fact that whether it is partnership or company, so long as you are involved in buying and selling, you are a trader. Now we are going to be looking at aspects revolving around more of sole proprietorship. You see, but we have other classes for that covering partnership and companies due to some terms that we use in these scenarios. But whichever way it is, whether sole proprietorship, whether partnership, whether company arrangement or corporate arrangement, if you are involved in buying and selling, you are a trader. Now, the final account of a trader consists of reports presented to the trader to show the performance of his business, including its assets and liabilities. What I'm saying is that for a particular period, it is expected to give the trader a report that shows how the business is doing, as well as a report that shows the assets, which happen to be the resources that the business owns, and liabilities, which happens to be what the business is owing to others. So a report consisting of these items or these information or these what they call it now, activities, is what we refer to as the final account of a trader. Now, the final accounts for this particular study, we're going to be looking at the trading account, we'll be looking at the profit and loss account, and the balance sheet. Now, there are other accounts, that can also be presented to the trader. We'll look at that in subsequent classes. But for this class, we're looking at the trading account, the profit and loss account, and the balance sheet. The trading account is a report prepared to show the gross profit of the business for a given period, usually a year. But it is possible to also prepare this report on monthly basis, or for a particular period as demanded by the management, or what we call the owners of the business. Now, the trading account basically is to derive the gross profit. And if you remember, in our accounting equation, we were able to establish that our gross profit is equal to our sales minus our direct cost. Now, you would need the accounting equation knowledge. So if you have not familiarized yourself to the accounting equation, you can go to the topic and then understand it before coming to this very class. It's on the YouTube channel as well. Just search for accounting equation and familiarize yourself with that topic. So let's go on. Now we are able to establish that our gross profit is our sales minus our direct cost. Our sales here can also be called turnover. Direct cost is all the cost involved, directly in bringing the product to the point of selling. You can call it cost of goods sold. So basically, we can say our gross profit is equal to what? Sales minus cost of goods sold. Now, because we have items that make up the sales and items that make up the direct cost, we present it in a statement or in a report. You understand now? To who? To the owner of the business. Now, the report that gives a bit of a detail and information regarding how we derive the gross profit is what we call the trading account. Now, the next one is the profit and loss account. Now, this is the report prepared to determine the net profit of the business for a given period. Now, the net profit is the difference between your gross income minus your indirect cost. What I'm saying is, by the time you derive your gross profit, it is possible to have some other incomes. When you add those incomes to your gross profit, take out your indirect expenses. Your indirect expenses are more like administrative and overhead expense. They are not directly related to bringing the product to the point of sale. So other expense, aside from expense that are related to bringing the product to the point of sales, are called indirect expense or indirect costs. So when you take your indirect cost from your gross income, you have your net worth. Profit. So the report you prepare to show how the net profit is derived is what we call the profit and loss account. So usually you can prepare the trading, profit and loss account together. Now, due to some adjustment in the reporting standards, we now have this report called comprehensive income statement. So instead of saying trading account and profit and loss account, we simply say comprehensive income statement. So whenever you hear comprehensive income statement, we are referring to the same trading, profit and loss account. Now, this is how a trading profit and loss account looks like. Using the accounting equation, we can have something as simple as this. I'm saying again, you need the accounting equation knowledge. It's going to help you understand this, in a very simple form. So now we have Agbenuga Enterprises. This is the business name. And then we have trading profit and loss account for the year ended 31st December 2019. I can decide to use comprehensive income statement for the year ended 31st December 2019. I'm saying the same thing. It's just that the standard has now changed the name that is being called, but it's still the same thing. So if you hear comprehensive income statement, I'm referring to trading profit and loss account. Now this is how it looks like. We have turnover. Turnover here is sales. You put the value there. Remember we said what? Your gross profit is your sales minus your direct cost. Your direct cost is same as cost of goods sold. So we have turnover here. That's the amount. So what do we do with less? That's more like minus. Cost of goods sold, which is the same thing as your direct cost. This is the less. This is what we're taking. That's why we're bracketing. We're taking it, we're minusing this from what? This. This is your turnover. And this is your cost of goods sold. So when you say turnover minus cost of goods sold, you have your gross profit here. Okay? Now, you have other income. Other income is maybe your business into some other activities other from the ordinary activity. You understand? So incomes derived from other activities or even from the same activity is what we call other income. So you add it to your what? Gross profit. When you add your other income to your gross profit, you have your gross income. So what next? You take out your what? Total expense, which is your indirect cost. The total expense is this. You see your bracket, and that means your lesson. So you minus it from your gross income, you have your net profit. That is your what? Trading profit and loss account or your comprehensive income statement. But you must note something. As you see, we have a column for notes here. You can see turnover. You see note 1. Cost of goods sold, note 2. Other income, note 3. Total expense, note 4. This is because there are some items that have been manipulated to derive the turnover. Some items have been manipulated to derive the cost of goods sold. Some items have been manipulated to derive the other what? Income. Some items have been manipulated to derive the what? Total what? Expense. So this note gives a further explanation on how your turnover is derived, how your cost of goods sold is derived, how your other income is derived, and how your total expense is what? Derived. So if we look at the next page there, you can see note 1. See, turnover, note 1. This is how the turnover was derived. Remember I told you, you can expand your turnover in the accounting equation. If you make sales, for instance, it's possible that when you make sales, say you made sales of 1 million, you can have some return back to you. That's what we call returns inward. So if you made sales of 1 million and you have like 100,000 return back to you, that will reduce the sales that you have made to 900,000. So when you manipulate that, you get your turnover. So that's why we have note 1 here, turnover, which is sales minus, whenever I see bracket here, I'm deducting. So minus returns what? Inward. So sales minus returns inward gives you your what? Turnover. That is what I'm quoting here. You can see turnover, note 1. This is the value. The next one is cost of goods sold, which is note 2. Okay? Your cost of goods sold is the cost of the item you have sold. For instance, if you're selling mobile phones, you have to buy it somewhere. When you buy it, the cost of buying it there is your cost of goods sold. But it is possible that we have some other items that can affect it, either increase or decrease it. For instance, when you purchase it, it is possible that you return some back to the supplier. That's returns outward. So if you purchase goods worth say 700,000 and you returned say 50,000 back to the supplier, it will reduce your what? Your goods purchased to 650,000. So it means that your purchases and your return outward, can be manipulated to get your cost of goods sold or your direct cost. Now, it is also possible that when you purchased, you spent your money, to bring the products to where you're selling them. That's carriage inward. So it means that it will also affect the cost of purchasing. So the cost of purchasing, you remove whatever return you goods you return back to the supplier, and then you add the cost of bringing the product to to the place of selling. That's why we have purchases here. You can see carriage inwards, we are adding, now that there's no bracket. Then you can see returns outward, we are deducting. But it is possible that because the business is a going concern business, that is, you have operated a previous year and you're operating the current year. It is possible that you have some goods you're bringing in from the previous year. Say this is 2019, for instance. It's possible that we have goods that we brought in from 2018. That's what we call opening stock of inventory. That will be added to the goods that we have purchased. So if, for instance, last year you closed with say 10 units of mobile phones, and this year you purchased additional 20 units. That means the total goods that you have to sell is 30 units. If you return say 5 units, that means the goods you have to sell is 25 units. Okay? And then if you spend some cash to bring the ones you purchase, you add it. Now, by the end of the year, it's also possible that you have some left. Say, for instance, from this explanation now, last year we closed with say 10 units. This year we bought additional 20 units, that's 30 units. Now we return, let's say 5 units to the supplier. That means we have 25 units. Now, if by the end of the year we have 3 units left, it means that what we have actually sold will be 25 units minus the 3 units, which is 22 units. That's the essence of the closing stock that we are deducting here. So basically, our cost of goods sold, or our direct cost, is a function of opening inventory, which is opening cost, purchases, carriage inward, return outward, and closing stock. Your opening stock will increase the cost of goods you want to sell. Your purchases, you bought more, it will increase the cost of goods you want to sell. That's why you're adding. Carriage inward, you spent money to bring the goods to the point of selling, to increase your cost of goods you're selling. That's why you're adding. Returns outward, you return some goods back to the person that you bought from. That will reduce the cost of goods you're selling. That's why you're deducting. Then closing stock, the unsold goods, will also reduce the cost of goods you're selling. That's why you're deducting. So when you manipulate these items, that gives you what you have as cost of goods sold. That is what we are quoting here. Cost of goods sold, note 2. That's the explanation. Then you have it here. You are deducting from turnover to get your gross profit. Now we have other income, which is note 3. Look at other income here. So we have discount received, we have commission received. So aside from the business you're doing, it's possible that in the process of doing a business, you receive some discounts, you receive some commissions. You add it together, that will give you other income. So whatever income, additional income you have made, aside from what you're buying and selling, you add it to your gross profit. So this is the manipulation of other income. You can see note 3 here. That is what we are quoting here as other income, note 3. So when you add other income to gross profit, that gives you your gross income. So we take out our total expense, that's note 4. Look at our total expense now. You see total expense. Some refer to it as administrative cost. Some refer to it as overhead expense. Some refer to it as indirect cost. We're saying the same thing. So what are the items that can be manipulated to get your total expense, administrative overhead expense, or indirect cost? Rent. For instance, you're paying rent, you're paying salaries, transportation, motor repairs, depreciation, carriage outwards. Carriage outwards is the cost incurred in moving goods sold to your clients to their place. That means you sold the goods to them, you spent your money to take the goods to them. That's carriage outward. So all these are what we call your what? Total expense, administrative expense, overhead expense, or indirect cost. So when you add them together, you have the total here. That is what you're bringing here as total what? Expense, which is note 4. So when you now deduct your total expense from your gross income, you have your net profits. So that's how it is. The straightforward statements or the reports. We have the notes, and then the notes are an explanation basically on how the items are derived. Now the next report is the balance sheet. The balance sheet is a report that shows what the business has in terms of property, or what we also call assets, and what the business is owing in terms of what? Liabilities. So basically, the balance sheet shows the business assets and the business what? Liability. So we can say it's a report that shows the liabilities, the asset of a business and the liabilities of the business. Or you can say a report that shows the financial position of a business at a given period. Now, because of the adjustment in the standard, we now refer to the balance sheet as the statement of financial position. So when you hear statement of financial position, you're referring to what? The balance sheet. Now this is how it looks like. You can see statement of financial position as at 31st December 2018. You can 2019. That's the year. Okay. So what the balance sheet shows you is what? The business is what? Assets and liabilities. Remember our class on what? On assets and liabilities. So you can go back and quickly refresh your memory about that. We were able to classify assets into non-current assets and current assets, liabilities into long-term liabilities and short-term liabilities. So basically, we have the assets, as you can see here, non-current assets. Note 1 to explain if we have various items making the non-current assets. That is what you have here. Other assets. You understand? Aside from non-current assets, you have note 2 explaining what comprised of the words other assets. That's what you have. So when you add this to this, you have this. The next one, current assets. So we have the notes here explaining items that make up the current asset. That's what you have here. So when you add this total non-current asset and other asset to what? Your current assets, that's what you have here as total. This is now what you call your total assets. These are your total assets. And then we have liabilities here. We have long-term liabilities. We have note 4. That's the breakdown to give you this. We have short-term liabilities, note 5. That's the breakdown to give you this. So when you add this to this, you have this. Okay, remember I told you, I said the owner's equity is also a liability to the business. Why? Because whatever the owner invests into the business is what the business is owing the owner. So your liabilities as a business is what you're owing others, including the owner. So we have owner's equity here. That's what the owner has invested in the business. So when you add the owner's equity to your short-term and long-term liabilities, you have your total liabilities. So at the end of the preparation, your total liabilities must be equal to your total what? Assets. As you can see, here are the breakdowns. You see your non-current assets, land and building, motor vehicle, office equipment, machinery, furniture. When you add everything together, that is what you have quoted here as your non-current assets. We have the current what? Assets. Current assets here. As you can see, we have cash at hand, cash in bank, closing inventory, debt. When you add them together, that is what is quoted here as the current asset. Then we have other assets. We have goodwill and patent. When you add it together, what is quoted here as other what? Assets. We have long-term liabilities, bank loan, mortgage loan, debentures. When you add it together, that's what you have here as what? Long-term liabilities. We have short-term liabilities. We have creditors, bank overdraft, unpaid. When you add it together, that's what you have here. We have owner's equity. I've already explained to you. Owner's equity is what the business is owing the owner. So if you invest capital into the business, you use it to operate. If you make any profit, it will increase the capital. If you make loss, it will decrease the capital. So here we assume that there's a profit which will increase the capital. We add the profit to the capital. Then we have drawings. That's if the owner of the business took some things out of business for his personal use. Some companies use director's current account. It's the same thing. So here you're reducing what the owner has taken out for his personal use. So your owner's equity is a function of your capital, your profit, and drawings. So when you manipulate that together, that's what you have here as owner's equity. So when you add the owner's equity to your total liabilities, or your long-term liabilities and short-term liabilities, you have your total liabilities here, which must be equal to your total assets. Now, these are other accounts that can be prepared aside from what we have discussed, which is trading account, profit and loss account, and balance sheet. Okay, you can also prepare this account, but this is going to be dealt with in detail in other classes. We have cash flow statement. This cash flow statement is a statement that explains how money is made or lost in terms of operation, in terms of investing, and in terms of financing. So basically, what did you make or lost in business operation? What did you make or lost in investing the business assets? What did you make or lost in financing activities? So basically, your activities are into either the ordinary course of business, your financing activities, or your investing activities. So at the end, you want to know how you are able to derive your cash and cash equivalents. The next one is value-added statement. Value-added statement is a statement prepared basically to derive the wealth generated by the business and how the wealth is distributed among stakeholders. Who are the stakeholders? We have employees, we have government. You understand? And then we're going to be looking at expansion of the business. Okay, and then we have financiers. Okay, so when you generate wealth, with the business, you're going to have to share the wealth among employees, because you use them also to generate the wealth. You're going to have to share the money with the government, by paying tax, because you're operating in a particular environment that has laws. You're going to have to share the money with investors. Okay, that's like banks. Okay, and then we're also going to be looking at expansion of the business. Okay, you're talking about leaving money to ensure that the business grows, to make more money. Then we have change of equity position, or what we call statement of change of equity. We just explained owner's equity. So you can have a statement dedicated to this if you have various activities increasing or decreasing the owner's equity. So you put them in a statement. That will call change of equity position. We have 5 years financial summary. That's a statement that shows how the business has done in the last 5 years. You can have some other statement depending on on the setting or on the business. If, for instance, the business has various units, you can have unit results or segment results. For instance, an insurance company, for instance, has various policies, maybe motor vehicle, life insurance, maybe even in the motor vehicle insurance, you can have maybe third party, comprehensive, act only. You understand? So all those broken down, because you have activities in those various segments, you can have segment reports. So you can have various other statements, but basically these are other statements that we're going to be dealing with, in other class. We're going to have a class on how to prepare cash flow statements. We're going to have a class on how to prepare value-added statements. We're going to have a class on how to prepare change of equity position and all other possible statements. So for now, these are other statements. So we're concentrating on the comprehensive income statement, which is trading profit and loss account, and the balance sheet, which is also called statement of financial position. So this is an explanatory class or note on final account of traders, which involve the trading profit and loss account, also called comprehensive income statement, and the balance sheet, which is also called the statement of financial position. We also looked at other statements. So this is the part one. For the illustration, you're going to have to look at the class for the part two.